Erik, how is your product different to other traditional and alternative investments that are out there?
In fixed income, it is hard to differentiate yourself from other managers. In equities, you can call yourself a growth manager or a value manager. I think for certain value managers over the last few years, the category started getting a subcategory called deep value. In fixed income, really, the opportunities in especially the hedge space, while mathematically extremely wide, is pretty much focused at the end to arbitrage, or long short really, if you want. So what differentiates a fixed income hedge fund from another fixed income hedge fund, I think, over time, is the appreciation of risk management. Fixed income is really a risk tool rather than a return tool. I think we've seen enough theory over the last century that equities is an infinitely better asset class than fixed income when it comes to returns. It is what fixed income does when equities don't do well, where you really start differentiating yourself from the pack. So for us, two things. It's looking at managing downside and create incremental alpha over time with good liquidity and lower volatility than the pack. And I think in more technical terms, then what that would imply is that a good hedge fund manager over the long term is the one who uses the lowest amount or a low amount of units of risk to generate a unit of return. And I think when we look at surveys, the knowledge of that or the skill set of that is probably missed by not showing Sortino and Omega ratios for the different managers. But maybe there's an extra level to that question also in terms of differentiation. I think we should also differentiate between hedge funds and long-only funds. So while we are a long-only business with a hedge fund, I think it's still a mindset issue. So I think that as a hedge fund manager, it is probably easier with that skill set developed over time, someone that's spent a lot of hours managing hedge funds. It is a much more 24/7 kind of line of business than traditional long only. The skill set is a natural fit to manage long only money then, rather than the other way around. I think it's much harder for someone that cut their teeth in long only to move across to hedge. It is a much more volatile environment. Selling something short does not come natural to traditional long-only people. And also the broader tool set is also slightly unfamiliar often to your more traditional long-only people. And that then leads me to the third part of the argument, and that is that there's still an obsession in the industry, in the broader savings industry really, to see hedge funds as a competition almost to long-only funds or managers versus one another. And I think this is disingenuous in the extreme. 2 years ago at the Hedge News Africa conference, we had a panel session which was chaired by Carmen Nel, Lawrence Pretorius, Mark Leroux, myself was on this panel, and the message that we tried to drive home was really that hedge funds should be seen as a satellite investment to a core portfolio. We've also seen that concept now starting to get hold in the long-only space, where you've got a pool of assets that is used in a traditional long-only manager space, and alternative managers now becoming the satellite portfolios to those core portfolios. And to me, this is where the industry should start looking towards to. If you consider that the fixed income hedge fund industry is but a fraction of the largest fixed income strat income fund in South Africa, then people should realize really that these should not be seen as competing asset classes or managers, but really as complementary.
Thank you very much for joining us, Erik, and giving us more detail on yourself and the firm. And thank you for tuning into Black Onyx. For more details on the alternatives, you can visit our website.